Well, hello, everyone. This is Aaron Philbeck here with Kai Association. I'm excited to be joined by Gautam Bhandari, who is the Chief Investment Officer and co-founder of I Squared. And we're going to be talking about infrastructure today. So, Gautam, welcome to Capital to Candid.
Thank you, Aaron. A pleasure to be here, and good to see you virtually.
Wonderful. Well, Gautam, I'm really excited to talk about infrastructure with you today because I think this is a moment in time of infrastructure's life cycle that has really changed the face of the asset class. Even just going back 10, 15 years ago, I remember a lot of asset managers kind of talking about infrastructure being a stable piece of the portfolio and kind of low risk, low return, inflation protected cash flows, and so on. And I still think that is true to some degree, but as we've kind of evolved over the past, I'd say even 5 to 7 years, it seems like the definition of infrastructure has gone much broader than kind of the safe assets that are there. So, having started a business during this period of kind of evolution, I would love for you to just take a step back and walk us through your observations of how infrastructure as a broad asset class has changed over the past 15 years or so.
Sure, absolutely. And so, look, I think I've been doing this now 15 plus years. I've seen the evolution. I happen to believe very firmly that it is still a resilient asset class. It still has inflation protection. It should be the ballast in most portfolios. What has changed is that, the classical PPP infrastructure, which was a little bit more of a bond-like return, where people focus, perhaps inordinately so, just on the contract and the vagaries of the contract and the strength of the contract and the letter of the contract. That has changed, right? And so, effectively, over time, that that absolute, you don't have to do any operational stuff. You actually don't need that capability. You can simply sign a contract and be very bond like. That has evolved over time. And I think two things have happened. One, interest rates have gone up, so that those returns have come down, and two, operational complexity is back in. So it's still a resilient, safe asset class, but yes, the nature has changed. I agree with you.
Yeah, it's interesting. So the safe part maybe of infrastructure, the PPP, inflation protected cash flow, contractual cash flow side of the business has been where a lot of the assets were being raised, maybe in the 2010s or so. And it seems like it's just gotten more competitive as people were looking for income sources during a low interest rate regime. But to your point, the complexity has actually gotten even more complex during that period. So, how do you kind of think about the competitive nature of the safe part of infrastructure with the fact that it's even more complex and that's more costly? The margins might be more difficult to expand. So you kind of have these two competing forces as you're trying to think about the income part of your portfolio. How do you kind of think about that from a deal sourcing and what makes sense in a portfolio?
Right. So I think from a portfolio perspective, what you want to do is diversify and get low correlation assets, right? So you generally look at beta and say, okay, what is low correlation so I can have an efficient portfolio construction so that I can be on that efficient frontier. So I think most of the infrastructure assets that we invest in continue to have very low correlation to the broader economy. They could be very simple things. They could be concession based. They could be quasi monopolistic, or simply infrastructure assets that are, of habit. So I think all of those characteristics still exist. What has happened was that if you go back 15 years, or 25 years, the government privatized a bunch of assets in the UK, in Europe, as well as in US, and those assets just changed hands. There were concession frameworks given, and over time, as governments sort of left the business, the operational complexity of these assets was handed over to the concession owner or to the infrastructure investor. So, as a result, these assets did become operationally complex. Not every investor was used to it. I would argue many investors still are not geared up for it. And some of them still believe that, if I just have a contract, It could be very bond-like. And I think that era has passed. Two things have happened. I don't think the regulatory and political environment is as stable as you would imagine by reading a contract. So that's a negative on buying a highly, I would say, regulated or a highly contractual framework. And the second thing, of course, is that the rate of change has changed. The number of assets that the government originally had is insufficient. To your point, many more investors are in this now because they all have recognized the benefits. And so you need to be able to handle that rate of change, whether it be technology or construction. So those two things are sort of have helped bringing this asset class into a more private framework, which is not necessarily bad. I happen to think is fantastic actually because you get paid for it.
Yeah. And it seems like, the US might be an exception, but, parts of Australia and other parts of the world have done this, I guess, relatively well in privatizing some of this, and the private sector playing much more of a bigger role in development and taking on some of that risk. In this new kind of environment where governments might be they might be strapped for cash, or they don't have the political will, maybe like places here in the US. What do you view the role of government in kind of the relationship between public and private sector today, and how does that differ from 25 years ago when it was much more kind of government led and government driven? What's their role in this new regime?
Look, I think it depends on the geography. So many sectors in the US, let's take energy as an example, have been heavily privatized. So the role of the government is largely we afford to provide a fair sort of marketplace and some fair set of rules to get you permits and things like that. But thereafter, it's a open market. EU has taken up the same concept. So, bilateral PPAs are largely illegal by as per EU law. So you need to provide your power, for instance, into a centralized electricity market and compete. So I think that's by design. And I think the critical element to remember here is that value has not disappeared. It's just migrated, right? Originally, a lot of value was in financing and contractual framework, and that has migrated to an operational framework, which is not bad because it's actually allows participants to pick up even more value if you're equipped to do that. So I think overall it depends on the geography. Growth markets are a whole new bucket. They never actually went through the classical PPP frame. They simply arrived directly into this framework where they could, simply contract out or give a concession and let the private operator operate as he pleases.
Yeah, and maybe one follow up question on that too. So, I think geography and kind of describing the differences is helpful. How do you kind of differentiate maybe more developed markets versus developing or emerging economies, and that role of government playing, defense, offense, setting kind of strategy versus taking a step back and letting the private sector do its thing? It seems like the role of government is very important in maybe some of those developing markets, whereas in places like the US or Western nations or whatever, it's a little bit more of an adversarial relationship. I don't know if you describe it that way, but how do you kind of think about, developing versus developed markets?
Yeah, look, I think the first observation I'd make, and if you think about it, I think over the last 20 years, I've seen both these markets converge, right? So at least on the investment grade part of the growth markets that we focus on, I think today, if I look at regulatory frameworks in many of these countries, they're quite similar, if not better, than most of the developed world. And you ask yourself why? Why is that, right? I mean, obviously, US and Europe started off with much better infrastructure. It was built, and that allowed that industrialization to take place. I think the first thing I would say is that the growth markets recognize quite early, perhaps led by China, that you need to invest in infrastructure if you want your population to do well. And they really embraced it. And there, since those governments, typically ran deficits, they actually invited private capital in. So it was easier for them to do it. And as a population, if you don't have a service and suddenly somebody provides it to you, you don't mind paying for it, right? So I think it's just very natural. If no road existed and somebody builds a road and charges a toll on it, it doesn't seem all that unfair, right? I think in the West, in US and Europe, it was a converse problem where using taxpayers' capital, frankly, assets were built, transmission lines, power plants, roads. And so as the governments went into deficit, it was harder for a politician to convince a tax-paying public that they should pay for an asset given that they had already paid for it once, right? So it was simply upkeep or an upgrade. Now, that's not cheap, by the way. Infrastructure is very capital intensive. And that's the reason why governments have been privatizing it and asking the private sector, mainly the pension plans and the insurance capital, to come in and provide that equity. So I think that effectively today I would look at it and say both these markets have converged in many cases, and depending on the subsector, sometimes the regulatory framework in growth markets is more time tested and better, and in other cases is better in developed markets. So you really have to be choosy and pick it. The final point I would say is the credit of both these markets has evolved. So back in 2000s, if you look through the Asian financial crisis, I lived through it. The developing world had generally 130, 150% debt to GDP ratios, and the developed world was generally 50 to 60. Today, it's completely opposite, right? So the G7 is running at about 128% debt to GDP, and the growth market world is generally running at somewhere in the 60s. So it's completely flipped. Our minds have not changed. We are still holding dear many frameworks that we learned 15 years ago, but the reality is completely different today.
Yeah, no, very, very interesting. And, I think your comment on you need infrastructure if you want your population to grow and have a good life. I think about here in the US, these bridges that we have are outdated in some areas. We've seen some collapses, and I think it seems like whether it's constraints or attitude or whatever, it seems like the other economies have been able to do this relatively well. I want to zoom back out into kind of the evolution of this space, and we've heard a lot in the last couple of years around AI, digital assets, electricity, updating the grids, telecom. These are all very big growth stories, and you see it in the public markets with the Mag 7. Venture capital has invested in a lot of this stuff. But a lot of the success of this, working comes down to infrastructure and the grid and the foundation that's going to support a lot of this growth. And so I'd be curious your perspective as an infrastructure investor, how you think about the opportunity of things like AI and data centers and uh, all of that kind of foundational support, with the fact that we've got physical constraints and land permits and power and red tape from governments. I'm trying to kind of reconcile this growth story that we see in go go go, equity markets and venture capital, with infrastructure playing a really important role. So how do you kind of think about those two things together?
So, Aaron, you're correct, right? I mean, AI was the last straw that broke the camel's back, right? So, if you think of it that way, we were sitting having underinvested in infrastructure, both in US as well as in Europe, for 20 plus years, right? So average age of bridges in the US is about 45. The only continent with older bridges than us is actually Europe, which is 50, which actually, by the way, is kudos to the bridge designers, right? The civil engineering work, that these are well beyond their design lives and they're still working. So I think the reality is that we as a society have not invested nearly enough. The report card, that comes out from the American Society of Engineers has been consistent, sort of D's and F's for frankly a decade, but it hasn't spurred any action politically, right? So I think the private sector needs to do that job. And I think the big impetus has been, as you correctly pointed out, AI, but also industrialization, right? So when you think about tariffs, tariffs are really about jobs. The intent behind tariffs, whether right or wrong, is to make sure that you have some security of supply, and that some population is still, engaged in useful employment in manufacturing and other high tech industries. So effectively, post COVID, the world has deglobalized, as everybody thinks. But I like to think of it as reindustrialization. So here we are in Europe, in the UK, in Germany. Every nation wants to make its industry competitive. Germany announced 500 billion euro package towards infrastructure. UK has the same plan. France has the same plan. US, quite deservedly, has the same plan, right? So effectively, every nation now wants to industrialize. AI is a big impetus. It's quick. The market recognizes it. The other element of AI, of course, is that AI is very power hungry, right? So that Google search that you do, if you happen to do it on Gemini, is about 9x more power. So I think that is driving a lot of build, not just in grids, but in power, but also in the basic infrastructure as US industrializes. So I've often said that this is an infrastructure super cycle that we are at the cusp of. I can see it clearly, having been in this for 20 odd years and having observed how slowly infrastructure moves. But I have never seen that urgency and that demand for infrastructure, that fundamental underlying demand for infrastructure as I see today.
Yeah, and I want to come back to both the super cycle and the tariff comment as well, just because I think geopolitics plays a role in this certainly as well. But before I ask those two questions, I'd be curious. So when I think of like legacy infrastructure, it's toll roads and seaports and social infrastructure and schools and hospitals and so on. So there's a very well defined kind of legacy definition of infrastructure. Could you spend some time just walking through those growth sectors and what have we bolted on to the old definition of infrastructure that now is kind of across the safe assets and then these more growth oriented assets like data centers that we talked about? So categorize it for me, if you will.
Yeah, sure. Look, it's a very fine grade, but I'll give it a shot. So look, I mean, classical infrastructure was PPP, right? So about 18 odd years ago, people would argue that airports are not infrastructure. So just to put it in context, today people say airports are core infrastructure. And the reason back then people thought airports are not, you know, classical infrastructure was because generally the beta is more than one, right? So if the economy is doing well, air traffic really exceeds it. When the economy shrinks, air traffic actually goes down quite rapidly. So the beta is more than one. And as a result, people also thought that there are many modes of transportation. There is no guarantee, and much of your revenue is from shops and things like that, right? So it's not just pure tax revenue. So I think definitions have changed. What is true is that airports are resilient. I think people have seen that. Other than COVID, I think they've had a pretty good run. And I think as a large owner of toll roads, I would tell you, uh, I, despite COVID and during the pandemic and all the shocks and the supply shock and the demand shock and the inflation shock, um, toll roads did exceedingly well, right? So they broke through all that way better than a restaurant, way better than fashion or any other thing that you can think of. So I think it held up. If there was ever a lab experiment, or if you wanted to do your PhD thesis on resiliency of various real assets, I think infrastructure would come out with an A grade. And it's both the classical infrastructure as well as some of the newer things into infrastructure. So if you think about a school bus business, right, which is just transporting kids to school, that some would argue is new infrastructure. But look, I mean, the way to think about it is whether the stock market goes up or down, your kids are going to go to school. So it's kind of irrelevant how the stock market does. Yeah, and so I think some elements of social infrastructure in the same thing. Aging is a human process. There's nothing to do with stock market. So I think it's useful sometimes to not think on those rigid lines, but I have always advocated that people think along the lines of resiliency, right? So is it correlated? Is the beta low? Is it repeatable? activity that is just going to occur because there is a fundamental need in the society, and not everything regulated is good. In fact, I happen to believe that regulated assets, especially in today's environment, are very political, and politics changes, and politics, frankly, since Roman times or Greek times, is roughly the same. So I think we have these 30-year assets. We need to think about fundamentally, are they quasi monopolistic? Are they repeatable? Do they have repeat customers? Are they habitual? Or maybe they're contractual. And as a result, I think these contracts stand the test of time. And along those lenses, I think you would find many assets have joined that fray. Of course, you have the classical toll roads and airports and ports, but you can add to that assets, frankly, today, such as cold chain centers, data centers, fiber optic networks. Remember, back then there was no actually fiber optic networks didn't exist, right? I mean, these were see like copper rings, right? So it's absolutely a brand new asset class that has come in. So I think the all infrastructure is private capital that tends to specialize. Frankly, that's what real estate is. If you go back enough years, everything was private equity. Even real estate was private equity. Some of the early Carlyle funds actually had real estate assets in them. But over time, people specialize, and that's a fantastic thing. You should specialize. You can get more alpha that way. And infrastructure happens to specialize around about five dimensions of power and utilities and transportation and digital and social. And I think within those sectors are quite common globally. And once you specialize, you can actually take advantage of that globally.
Yeah, and I like that maybe more simple definition of if the stock market falls or things fall apart or there's a pandemic, these things persist regardless. And you're right.
Correct.
I live in outside of Philadelphia, and I had to pay the tolls when I went home to see my family, regardless of what was going on in the pandemic. So, yes, they were resilient because of me in that context.
And
Um,
Aaron, for it, right? You get up in the morning, you turn on the light. Whole bunch of infrastructure investors got paid. The transmission guys got paid. The power generation guys got paid. You look at your iPhone. Well, guess what? The data center guys got paid. The fiber optic networks, the cell tower companies got paid. So infrastructure assets don't necessarily need a brand name. They work, they're there, they're resilient, and people use them, and maybe they pay pennies every time you use them, but they're always there. So you're not actively quote unquote every day deciding who your phone company is. And frankly, even if you decided who your phone company is, the fiber network's common. So it's going to write the same network, it's going to probably write the same data center.
yeah, yeah. I want to finish up with two questions. One on geopolitics. So I will start there. You mentioned tariffs, but and you also mentioned Germany and the UK, and there seems to be a very concerted effort around the world to reinvest in local economies from an infrastructure perspective. And some of that might just be economic development and trying to stimulate the economy. But there seems to be a very clear kind of jockeying of positions among certain nations of supply chain routes and resilience and maybe self sufficiency is maybe the driving force of this. So, as an investor in global infrastructure, how do you kind of see the role of geopolitics playing a role in opportunities, but also maybe some potential risks in some of those underlying deals?
Right. So I think the first thing that I like to do is actually think locally, right? So we act globally, but we think very locally. And what are the nation's priorities? And generally, from of course, at the big picture, everybody wants to industrialize, but what are the core strengths? What are those sectors that they would like to actually have an edge at, right? What are they exporting things that they would never touch? So if you take Mexico and as an example, nearshoring is very dear to them, right? So when it comes to nearshoring, the government is very accommodative. So anything you do that supports that nearshoring effort is welcome, right? Similarly, many export-led economies have the same sort of thought. So I think we try and build and buy and actually operate things that are near and dear to the local sort of push. Um, and I think that has always been fine. And the second thing I would tell you is if you have commercial contracts, you're generally fine. Commercial contracts withstand the test of time. The third thing, which is also to avoid, to the second part of your question, what are the things you do to avoid? Because it could be a risk. We try and be below the radar screen, right? So no politician would ever put a tweet out for something that is, you know, 500 million. The $10 billion projects, sure, they tend to be controversial, lots of complaints, lots of local opposition, international geopolitics come in. But smaller projects, sub-billion, rarely ever make the news because they're quite boring, especially today. In today's economy, everybody likes to talk about 100 billion and trillion. So fantastic numbers. My job is actually not to do any of those projects. My job is to do actually very simple commercial bilateral type of projects or other projects that are below the radar screen but align with the nation's priority. The final thing I'd say is every nation wants to industrialize. I have not seen a country that actually says, no, actually, I want to do nothing. I've never seen a politician who says that. And some of it is understandable, right? Because especially as you think about the decade ahead with AI, as jobs get under threat, I think people want that security of supply that came through in the pandemic. But also people want to make sure that certain critical industries should be close to them and they want to specialize in them. Whether it's right or wrong, frankly, is not my role. I think that's the decision the society has made. And I think you cannot industrialize without infrastructure. The only competitive advantage you have is if you have very good infrastructure, your cost of industrialization, your cost of goods tends to be lower, it tends to be more efficient. And a case in point is China, fantastic infrastructure, over 2 decades of spending 9% of their GDP to build world-class ports and roads and power grids and power plants. And as a result, they became the manufacturing engine of the world. And I think the way I think of this is that US, Europe pretty much outsource their infrastructure to China.
Mm.
Right? We didn't have to spend 9% because somebody else was spending 9% and we choose to spend 2, 3% of our GDP on it. And so after 2 decades of that, you have a huge deficit. And then suddenly society realizes that your apartment looks great, but the infrastructure is not great, and so you want to spend on it. So that's why it has become a priority. And it so happens to be a time where governments are running record deficits. So guess what? The government's not going to do it, nor does the government have the capability any longer. So it doesn't have those thousands of engineers on staff that could actually go out and build that infrastructure. So it is private sector and people like us with private capital who are actually builders whose job it is to go out and do those projects, which is fantastic, by the way, because private infrastructure is generally cheaper and runs more efficiently than government built infrastructure.
Yeah. Well, so maybe a closing question for you, and in your super cycle language, as you kind of look out next decade or so in the infrastructure super cycle, what are some things that you think are going to define the cycle? And that could be political, it could be environmental, it could be physical. What are some of those things that you think will define the future of infrastructure over the next 10 years?
Look, I think the first thing is, of course, energy. As humans, since I think our cave days, we have been massive consumers of energy. And AI, as well as manufacturing, localized manufacturing, is hugely energy intensive, especially in a world where I see robotics and AI and other things to assist in manufacturing, right? It's not the same manufacturing as 50 years or even 20 years ago. It's just a different way of making goods. So I think that amount of energy production and its transmission, and it really starts everywhere, right? Because we maybe need gas molecules, or you need the renewable plant, then you need the grid, then you need to stabilize the grid, and then you need to, transport those electrons to the right medium to then connect and convert them into photons post your compute. So I think that seamless build out, which I don't think humans have ever done in any lifetime, is ahead of us. So I think that build cycle is the largest capital expenditure ever in human history. It is occurring simultaneously. It's a national priority for most nations. I think there's almost a race, as you've heard President Trump talk about it. You can hear France and UK and every nation trying to race to actually develop that sort of modern infrastructure. And I think that on who builds it and how fast they build it will define their place in this race of nations. And frankly, for most of the time, it's not capital that's the constraint, it's humans, right? It's the permits, it's the application process, it's the lack of land, it's the local opposition, the one politician who, has an issue with it, right? So that's the real world. And then execution is where value is created or lost. And I think as I squared, my focus is on making sure as builders of infrastructure that our execution is flawless. And it's less about finance and engineering. It's more about actually developing and executing these projects.
Wonderful. Well, I think that's a great way to close. Gautam, thanks so much for sharing your thoughts. I've learned a lot here in 30 minutes or so, and this is a fascinating space, and I think will continue to change, even as you just said, over the next 10 years, even relative to 10 or 15 years ago. So excited to watch it as that unfolds. But thanks so much.
Thank you. I appreciate it. Thanks, Aaron.